Hello everyone. So today I decided to shoot a quick video simply because a lot of people are, either scrolling on their Facebook, Instagram, TikTok, and whatnot. They're seeing all these insurance ads, life insurance ads just pop up, and some of these ads are just totally misleading in the way that they present themselves. The rates that are out of, whack, it's just out of reach, but they still advertise just to lure the clients to, click on it, to submit their information to see what they can get. Obviously the approach itself is not wrong, like it's not illegal, but obviously some of these are highly misleading. And if you don't know any better, you can quickly fall the victims of some of these, aggressive marketing tactics. So today what I decided to do is I'm sharing literally my own Facebook feed here. I'm gonna scroll down and see, what I see on my feed to see like what pops up. I've actually clicked some of these insurance, ads so that the algorithm will now know that I'm actually looking for life insurance for myself, right? So let me go ahead and walk you through, or I guess I'll just do like a quick a review of some of these feeds here, so you know like what we're gonna come across with here. So let's see. So first one I see here is this one, Canadian Life Insurance Guides. I've seen some of their ads before. So they're saying, okay, so I think their main thing is that they want to sell a money back guarantee life insurance. So yeah, money back life insurance doesn't exist, and then the question mark. I think if you click on this, they will take you to their website, and you'd have to fill out like a certain form to see if you qualify. Everyone will qualify, right? Obviously. They're just trying to get your information. So with the money back life insurance, typically the way these are structured is either one of the two ways. Okay, so either you have a participating whole life that pays dividends in the future. So it requires you to either put down a huge lump sum payment into the policy, or for you to aggressively pay a very high premium in the earlier years of the contract, typically anywhere from 10 to 20 years. And then the cash value of the dividend will basically pay out later in the year. So that if you do a quick math over the course of, let's say, I don't know, like 40 or 50 years, the amount of the cash that will accumulate, or the money that you will get back in the later years, will be much higher, substantially higher than what you put into the policy. Now the problem with those contracts is that, as I mentioned, with the participating whole life contract, it does require you to put down heavy amount of cash. Okay, heavy amount. So for example, if your expectation for these coverages, or for these plans to give you X amount of returns on your money, let's say like 2 times your money. Let's say your goal is to, I don't know, like end up with $100,000 inside your life insurance policy. Well, what will happen is they will likely require you to pay a lot of that up front, like over the course of 10 or 20 years. So you will be making like tens of thousands of dollars as an annual payment, or like if you break it down to a monthly payment, you'll be required to pay like $500-600 per month just for the policy to be structured properly, so that you can actually enjoy for those benefits. So that would be like the more of a safe way to have it structured. But you can see that the risk with that is twofold. One is that it requires a huge amount of capital upfront, and the second is that it requires a long time for that to pay off. Okay. So that is nothing new. It's once again a concept that is well known in the industry, but I think the way they are advertising is obviously, oh, get money back guarantee, which is obviously very nice to hear. Some of the other possibility that they might be presenting their products or presenting their plans. And like I said, full disclosure, I don't know anything about these guys, so I'm just making an educated guess here. But like I said, it's very likely that they have these products that are well known in the industry, and they're just repackaging it to make it better, make it sound better. The other approach might be that they're selling a universal life policies, which is a big no-no. Okay, so universal life insurance is a type of life insurance that encompasses the investment component in it. So what happens is, let's say for example, you're paying a monthly premium of, I don't know, like $300 a month. Just to use an example, like if you're in your 40s or 30s, you pay that every month, and what happens is a portion of that payment goes to the funding of the actual cost of insurance, so what the death benefit is actually worth, and the difference goes to an investment account within the insurance policy. Now, the investments are typically tied to market-based performance products like mutual funds, but only that because life insurance contract cannot hold mutual fund, as itself, simply because the insurance industry is not regulated by the mutual fund industry. So it will basically use what's called the seg funds, or segregated funds, and oftentimes the universal life insurance products that have these seg funds in has a huge, higher, the expense ratio, MER, higher fees that you pay for those managed for the investments to be managed compared to if you were to buy that exact same investment outside of the universal life policy. Okay. So the key thing with that is because it's at the end of the day, it's still an investment. So that's not guaranteed. So what a lot of the advisors who are rookies or the ones that are new to the business, they don't know this and they try to sell the universal life to clients. They sort of present these kind of products as like a retirement fund, right? Or something you can really get rich off of like later in the years, which is highly, highly misleading, especially if you are just basing your projection of the growth based on like simple illustration. Illustration is nothing more than like a future projection of constant growth. So if you assume that your investment will grow at an X amount of percentage every single year, which never happens basically, let's say like you get like a very good rate of return, like 8% every year. So you end up with how many years you put money in every year or every month in this case, and then you multiply that by whatever years a compound rate of an interest rate, and you end up with like this gigantic sum like in the future. Obviously, that's very nice to see on the paper, but those are never guaranteed. Okay, so you as a client assumes the full risk of those investment product or risk associated with that product. Your advisor has nothing to do with the plan. So they may say something like, "Oh, we're gonna do a review. Like this is gonna be like me managing your money." They're gonna make it sound like they're like some sort of an investment or portfolio manager that actually is managing your finance. Nothing could be further from the truth. Okay, so the universal life insurance is one of those products where it's typically not recommended to the Canadian public. It's a very niche product. You have to be very investment savvy. You have to have a high tolerance for risk in order for that to actually work out in the future. So if you're not one of those, if you don't belong to either of those camps, you should not even be buying universal life insurance. Okay, universal life insurance also pays the highest level of commission out of all the life insurance contracts out there, which is why you may think that some brokers might entice to sell universal life over others, right? So don't be fooled by that. If you've been approached by a broker that you need to have universal life and not for any good reason, you should avoid that altogether. Okay. So that is what I can sort of tell you to you guys watching this video. If in case you do check these guys out, and if one of these, the product I just mentioned happens to be what they're offering, now you know exactly what to watch out for, right? So scrolling down, and I don't want to obviously reveal some of these names here, but let's see. Okay, so here's another one. Oh, Dundas Life. Okay, so Dundas Life has an ad. So yeah, 50 plus years old, 100,000 non-medical life insurance. You probably see a lot of these kind of ads. Now, this ad, the way I like this ad is because once again, it says it has a full disclosure, right? So it has at the bottom right, based on a 10-year, 50-year-old female non-smoker in good health. So that this is not misleading at all. So if you are 55, if you're 60 or 70 years old, the ad is telling you already that this rate here that they're advertising is based on a perfect, someone who is in good health, 50-year-old on a 10-year term for these, figures. So for 100,000, so if you are 50 years old or younger, you could reasonably expect to get these rates. Otherwise, if you're older, obviously you know that this rate is not for you, so you may pay a higher rate. But the problem that I have with some of the other ads that are being advertised is that they don't have these sort of disclosures. They simply just advertise like a fixed rate for like a certain health profile, and they don't tell you what that rate, who that rate is for, and what they instead do is, like this rate is available. Well, that's not going to cut it, right? Like, I mean, if you're like an older individual, and you know that those prices are out of reach, but you're still, enticed by the ad because that their prices seem so outrageously good. It probably is. If it sounds too good to be true, it probably is, right? There's nothing really new under the sun. So that's something you have to realize. Oh, this is another one. Policy Me. It's another prominent, I guess the insurer. So they're doing the comparison here. So look, they're even giving out the profile of the client, right? So life insurance policy, March 4th, 1983. So this is the profile they're using, 15-year term for 500,000 coverage. They're saying that Sun Life is charging $45 and some change, BMO 38 and 70, RBC 38, 38 and 39, and Policy Me 37.20. So they have the lowest rate. Now, so they do have the lowest rate, by the way. So based on this profile. However, one thing they may have forgotten to tell you is that Policy Me's policy specifically, they do not have a conversion option built in or a renewal option built in. Not in a traditional sense at the very least. So how their renewal works is that As soon as your term is over, so in this case with the 15 years, at the end of that, with any other carriers or standard, insurance company carriers, they would allow you to renew for another 15 years, another locked-in price based on your age. So in this case, I'm seeing here once again, Policy Me or RBC, for example, right? So they're charging $38.39. Their renewal at the age of 55, at the end of the 15th year, it might be something like $100, $150, but that rate would also be locked in for another 15 years until the person is until the age of 70, right? So in case with the Policy Me, how their renewal works is instead of locking you in for another 15 years, they will now enter what's called the yearly renewable term. So every single year, based on your age, they're gonna charge you a fixed rate. So it'll be the rate that's based on your age, right? Regardless of your health. So the good thing is that just like any other terms out there, you no longer have to provide medical evidence in the case if you've had any major health events, right? That you will not qualify if you were to get a new coverage. However, the issue is that their renewal is happening every single year based on your age. So eventually the prices can become quite expensive by the time that you renew. Um, because once again, it's not a flat increase. It's basically, based on your age at the time that you renew, and it happens every year. So that's one thing they don't tell you that, like on this ad, for example, that's not visible because they're positioning their product as if something that is exactly the same or identical to that of like RBC, BMO, or Sun Life, but they're not. Okay, so RBC, BMO, Sun Life, what they have all have in common? Once again, they have their renewability, guaranteed, renewability built in, and also it's convertible to a whole life insurance, which is also missing with Policy Me. So with Policy Me, how their conversion works is that you are able to convert, but not into a whole life. You're able to convert into a term life, so you're basically able to extend the term only up until a certain amount of years, right? So you can never convert it into a whole life insurance. And I think their option for conversion is only allowed within the first 5 years of your policy starting, right? So in this case, with this person here, like the person is buying the coverage at the age of 40. If the person fails to convert by the time he's 45, that conversion option no longer exists. Okay. Once again, this is not industry norm. Most of the insurers nowadays, with including RBC, Bank of Montreal, or Sun Life, they will allow you to convert a term life insurance into a whole life plan without any evidence of insurability up until the age of 65, or in some cases with other carriers, like for example with Empire Life, they allow you to convert your policy up until the age of 70. So these are the main things that you got to watch out for. And so if you were an average consumer, going on about and looking at these ads and thinking that, oh, like I see that the Policy Me has the lowest rate, I should just pick them. Well, but that's not a fair comparison. It's not an apple to apple comparison, as you can see here. I mean, of course, the prices are very similar, but you're not really getting the same guarantees or same promises or same contract even, right? So once again, you're not going to know this unless you're an insider like me, where we have a lot of experience. We're dealing with pretty much everyone. We know what to watch out for. The clients are not going to know what to ask of these questions, which is why it's very important for you to actually work with a competent broker rather than trying to figure this out on your own or trying to shop around. I get clients all the time where they say, oh, you know what, I'm going to go call multiple places or I'm going to speak with multiple agents and then see who comes out best. Well, this may work like if you're shopping for like a TV or like a car where it's like, you can compare things, right? Life insurance is very much different. This is the reason why there's a license for the advisors, because once again, it can be a very complex topic. So I would just, ask you, if you are watching this video, the best thing you can really do is find a competent broker that is trustworthy, that will watch out for your best interest, and then basically leave them to do the good job, right? And basically get them to find you the best product. So that's really the best thing. Of course, this is not to say that you should complete the person, completely, or trust a person completely. But obviously, the person who will educate you through and guide you through, who in a transparent manner, that will basically act as your partner in your search for these products, rather than someone who's just trying to lowball you with the prices, right? And then only for you to realize that later on that you didn't get the same policy that you thought you were getting. So once again, that's the reason for this video here, is to make sure that not everything meets the eye. Once again, the highlight is the fact that you should definitely speak with a competent broker like us at Familia Life, where we do bring years of experience and expertise, who have access to a wider market than so that we can present you all the best options tailored to your needs. But yeah, until next time, stay safe, and we'll be shooting another video very soon.